members, stakeholders of the Uganda Institute of Banking and Financial Services. Good afternoon, everyone, from wherever you're tuning in. We continue to bring to you a series of webinars as we move on with the Banking and Financial Services Awareness Month. Whose theme is Be Money Smart, Your Money Can. Today, we're starting the third week, and we've been having a series of webinars from last week, the previous week when we launched our week, that's the month, Banking Financial Services Awareness Month. And we had the investment and loans week, where we had different speakers talking about investment, retirement, and loans. We request you to check out our portal, www.yourmoneycan.or.ug, where we'll find all the previous engagements we've had, previous activities, and all events that have taken place. So today we are talking retirement. We've saved, we've invested, we've borrowed, put our money right. Now we want to see how can we have a successful retirement. And you must notice that there also needs to be planned for early. So I'm glad to bring to you one staff at Uganda Retirement Benefits Regulatory Authority. That's Mr. Martin. Mr. Martin Tugume will be taking us through today's session about planning for an early retirement. So we need to know, we don't need to worry anymore. I must confess that some people get worried about retirement on this topic, on how to have and how to plan basically for a happy retirement. Allow me introduce to you our today's facilitator. That's Martin Tugume, who is the planning officer at the Retirement Benefits Regulatory Authority. You can call it UBRA, Retirement Benefits Sector Scheme. Having worked with NSSF for over 4 years in the capacity of data officer, benefits auditor, and compliance auditor. Prior to joining the UBRA, where he is currently working, given his prior engagement with Uganda's largest fund, that is NSSF, so we are pleased to have Martin, who has a blend of both the NSSF and UBRA, and current engagement with the retirement benefits sector. Martin possesses a very adequate understanding of both the operational and digital business aspects in the retirement benefits sector. He holds an honors bachelor's degree in quantitative economics from Makerere University and has a master's degree in business administration of Uganda Management Institute. So I'll be glad to introduce you just like those few words. And of course, as you'll be unveiling to us, I will come Mr. Martin Tugume to give us the day's package as we all tune in. Call your friend to call a friend, and we listen on this topic of planning for a happy retirement. Actually, it's early planning. That have to emphasize that the planning has to start early so that you can enjoy a happy retirement. Over to you, Martin. You're welcome. Good afternoon once again.
Okay, thank you so much, Benedict, for the insight and the introduction. I also wish to welcome all the participants on this webinar. And I should state that I will dive through my presentation. And for purposes of us moving swiftly, I think I will present, and then after my presentation is when we shall do a Q&A session. Of course, for the better bit, it's actually appreciated that issues to do with retirement are only better tackled from the aspect of the Q&A. So I'll make sure my presentation simply gives you an idea of what it is that we're going to talk about. So wherever you have questions, please take note, and then we can handle them in the end. So what should you look out for in this? I am going to briefly talk about the general statistics, but of course my bias is going to be more in lines of course, retirement and retirement planning. Then, of course, I will do justice by talking a little bit about the regulator for the retirement benefit sector in the country. Then I'll give a little insight on the outlook of the sector and talk briefly about its performance. Then we'll go a little bit into retirement insight, which I'll try to personalize and move away from the institutional and sector arrangements. Then I will share with you a little to do with the priorities and the way forward from the angle of the sector. And I think from this, you will see how best you fit in as an individual regarding your retirement planning. Well, now, if I can take you through the general statistics, of course, you could state that maybe these are outdated because these are basically from the census report of 2014. You might want to take note that this is done once in 10 years, that is the census. But I want us to just pick a few things that should communicate to you even now. For example, of course, the population at the time was about 34 million people. Currently, it's something about 40 to 42 million. I mean, that may not speak so much about what we want to talk about now. But I'll jump down to looking at the figure for the labor force employed, which is at 15.6. This was as at the census. But then when you try to reference it with the labor survey of 2016-2017, this figure was at 15.3, so which is what we are, I mean, same range of what I want us to talk about today. But then more to that, I would want us to interest ourselves in the proportions, the old age dependence ratio of 5.5, the life expectancy and what it means to you, especially with me wanting to state that the life expectancy has increased from 43 to 63 years. That is, if you looked at the two last census. And of course, you shouldn't be surprised that if it's done again, come 2024, this expectancy is expected to increase. But then beyond looking at the general stats, I mean, what do you have to think about? Yes, fine, 15.3 are employed in the sector, I mean, in the different sectors in the country. But surprisingly, only about 3 million of these are in the formal sector, meaning 12%, which is about 80%, is the informal sector. That's an issue that I think when I'm presenting further, you will get to appreciate where I'm picking from. Then I also want you to interest yourself in the statistic of the 66.3% of the senior citizens, that is persons aged over 65 years, who actually continue to work, much as they're actually old, they're above 65. You'd expect that they saved enough for them to enjoy their retirement. And then maybe to also state statistics from world over, I mean, specifically tailored to the country, Uganda, show that life expectancy at retirement stands at about 17%. So on average, someone retires at 60, that is the formal retirement age, you expect that on average, they will live up to the age of 77. Now, I will briefly talk about UBRA. UBRA is a regulator for the retirement benefit sector, and in full, that is the Uganda Retirement Benefits Regulatory Authority. We came in force by an act of parliament, that is the 2011 UBRA Act, and getting a little bit into what our functions and mandate rotate around, we are tasked with the regulation and supervision of the retirement benefit sector, but also as well with the duty of having to protect our members' interests. And of course, the bit of protecting members' interests, I mean, encompasses issues of complaints and whistleblowing and registration of dissatisfaction, name it. And then we also license the sector players, that is basically the different service providers we have on the market, the different schemes, then we undertake public awareness. All these are tailored towards the development of the retirement benefit sector. And then we are supposed to advise the Minister of Finance, Planning and Economic Development on all matters pertaining to the retirement benefit sector. It is the Ministry of Finance because that's where we report to. And then finally, we implement all government programs relating to the retirement benefit sector. Now, to begin with, our UBRA Act, that is the 2011 UBRA Act, of course, gives us the mandate of licensing schemes and service providers. But then specifically looking at our section 33 of the UBRA Act, it requires that there should be a segregation in terms of who does what in the sector. Now, what this may mean, I will use a little examples just to be sure that we're moving together. Now, what this means is we have a scheme, but then the scheme cannot do the investment, it cannot do the keeping of the custody and keeping of whatever assets it is for the scheme. It cannot do the administration all by itself. So each individual scheme is by default supposed to outsource the different functions. And of course, the whole bit of outsourcing is for purposes of enhancing scheme level governance. Now, looking at what our sector looks like now, and of course, a little talking about the coverage statistics, we have what I would call the tier one, which is the senior citizens grant. Of course, this is not, it's not contributory, meaning people do not have to contribute to it. It's a government initiative where persons, qualifying members, get a stipend of about 25,000 on a monthly. And who are the qualifying members in this case? You're looking at senior citizens. Of course, there has been a recent age revision from the 65%, the 65 years, pardon, to 80 for one to qualify. But in addition to that, you shouldn't be covered by another scheme, say the public service scheme. For you to fall under the category of a senior citizen and to be covered by this grant, you need not be covered by any other scheme. Now, that aside, as I talk about these tiers, can you try to position yourself and imagine where you would want to fall? Because I do not know whether my dear participants here would really want to fall under the senior citizen where you receive a 25,000. Because already you may ask yourself, is that adequate? Would that really be enough for you? But well, those are questions you will pick up as we go along. Now, the second scheme that I will talk about is the National Mandatory Scheme, which many of us know as the National Social Security Fund. Well, of course, this covers the private sector, and currently it mandatorily covers those employers that employ not less than 5 employees. Maybe to also mention is that the same NSSF as well runs a voluntary plan where members that qualify to participate on a voluntary basis, that is either you are a former member of the NSSF or you're working with an employer that's having less than 5, you can still elect to participate in the NSSF under the voluntary plan. Its coverage is close to 2 million. I must state that the figures that I'm talking about now hinge more in terms of the enrollment, the registration, because if you now went down to looking at issues to do with activity rates and the likes, that would change the whole figures. But then the activity rates and the likes, I should talk about that in just a bit. Now, the other tier 3 arrangement is comprised of the mandatory employer-based schemes. And under this, we have 3. One is the public service pension scheme. Of course, you know that this covers the traditional civil servants, and it's currently an unfunded defined benefit scheme. But maybe to bring you up to speed, there are reform proposals that are aimed at turning it from being unfunded to getting funded. And what that really means in the layman's language is currently the civil servants that are covered by the public service pension scheme do not contribute into the scheme. But the reforms that are ongoing are aimed at making sure that the members are able to contribute. So that they can contribute same way as it is for the NSSF. Now, the other constituent of the mandatory employer-based scheme is the armed forces pension scheme. Of course, this covers mainly men in military, and maybe to state that information relating to the armed forces pension scheme is classified. So you may not be able to get to know, how many army men we have. Of course, ideally, that's what would comprise of the scheme. So the third members of the mandatory employer-based scheme is the parliamentary pension scheme. And this scheme covers basically our members of parliament and employees of the Parliamentary Service Commission. Now, all those different 3 arrangements give us the total coverage in terms of members of about 392,000 as being members that belong to that tier 3. But as I stated, this number does not include the armed forces. Now, tier 4 is what one would call the supplementary voluntary occupational schemes. Of course, maybe to state that when you look at tier 2 and tier 3, these are schemes that came into force by an act of parliament. Whereas when you look at tier 4 and 5, these are schemes that run on trust law. meaning they are guided by a trust deed and trust rules. Now, tier 4 is a voluntary in nature, yes, but it's occupational, meaning this is usually started by employers based on wherever you work. An employer passes a resolution and says, I think in addition to the mandatory arrangement of the NSSF, I will subscribe or I will get my members to do a supplementary kind of contribution in a voluntary arrangement. And the difference with that, I mean, against the voluntary individual schemes is basically that for the voluntary individual schemes, you can join as you, I mean, Martin, I can join as Martin. Whereas for the voluntary occupation, it has a little bit of attachment in terms of your workplace. For example, if it's an occupational scheme for UBRA, it would be maybe say UBRA retirement benefit scheme. So you can only join it if you are a member or an employee of the authority. Now, beyond that, I want us to look a little bit about the contribution rates. Now, contribution rates, of course, kind of contribute to the accumulation phase of your retirement planning. I mean, and I'm saying that the mandatory schemes on average, it's 20-10, where the employer contributes 20% and 10% is from the employees. Of course, this is on average because I have considered all, in this case, I've considered the NSSF, the parliamentary pension scheme, and of course, remember the public service scheme is not contributory in nature. Now, the supplementary occupational schemes that are started by employers, of course, the contribution rates are 7.8 and 4.4. Of course, these are still very trivial figures that we are seeing. And whereas when you try to look at the supplementary voluntary individual schemes, the minimum is 2,000. And why the 2,000? When you try to look at what these schemes are characterized of, one, of course, voluntary participation, because they're voluntary schemes, but then they have short lock-in periods. That is basically for enticement of enrollment and participation by the public. They have an aspect of low density and frequency of contributions, ideally because they're a little bit more tailored to individuals, and maybe just so to say more tailored to self-employed and informal sector workers. They consider the aspect that these guys do not have a continuous inflow in terms of money on a monthly, like for a formal sector employee. So they kind of cater for cases where you may want or may only be able to make a single contribution in a quarter, and that kind of flexibility. And then you can actually use mobile money platforms and banks. I mean, that's basically for the aspect of convenience in terms of how do you get enrolled. Now, I'll quickly run through a little regarding sector performance, like really, really broadly. Maybe to state all that I'm sharing is simply to give you, I mean, an idea of, in the end, what is it that we are going to discuss when we try to tailor this whole retirement planning to us as individuals. Well, looking at sector assets, these have grown, of course, from 2015 to, I'm using 2019 because of the sector reporting cutoff period. But when you look at 2015 to 2019, there has been an average growth of over 20% in the sector. Of course, one would ask why the growth. Of course, the different attributes in terms of increased coverage, that is in terms of the people that are onboarded to actually begin participating in these schemes, has grown over the years. The other aspect is an issue of increased confidence in the sector, basically because of the operationalization of a regulator. People have a little enhanced levels of trust and confidence in the sector, I mean, implying increased participation. And of course, in the end, with the contributions, that would increase the sector. But all these are also supplemented by investment returns. That is, in terms of the returns on investment of the different assets after successful investment. Now, there wouldn't be growth if at all the negative forces were, of course, greater than the positive. And by the negative forces, I'm looking at things to do with benefits payouts. I'm looking at things to do with operational costs. Now, over the years, when you look at the net contributions in the sector, that is simply get contributions and net of benefits paid, there's been a positive maintenance, meaning month in, month out, what comes in terms of contributions can over and above cater for benefits. But then also there's been improved operation. these different scheme arrangements. And of course, that has in the end meant that the cost to income, cost to asset ratio, I mean, have dropped. And in the end, of course, this pays back in terms of increased assets growth. Now, the sector currently contributes over 10% in terms of the contribution to the national gross domestic product. And of course, I put a note there that UBOS did rebase, they adjusted the base year. That is basically what happened. And of course, that affected the initial earlier figures. And this note is basically to answer questions of those who possibly might have listened in at some time, say in 2018, and maybe the contribution to GDP was way higher than the 10.1 that's stated here. It was basically because of the rebasing. And then a little insight for you is that the sector currently is valued at over 15 trillion. That is in terms of what it is, in terms of the worth now. Well, I will proceed and look at a little to do with the sector operational aspects. Most of these that I have actually already talked about. I will interest you in the ratios, the cost to income. Of course, this basically looks at what is eaten in terms of operation costs vis-a-vis what comes in terms of investment incomes and stuff. Like you can see, of course, the proportions are way small. Basically, how is this good for you? It simply shows you that the incomes that get into the sector that of course later trickle down to members are not eaten up as much by costs of operating these individual schemes. Then when you look at the benefits contribution ratio, what this simply shows, for example, if I looked at the 2019 ratio of 38%, what this simply means is in the whole year, the 2019 reporting year, if you looked at a proportion of 100% being the contributions, only 38% of the 100 went out as benefits, meaning there is continued growth even vis-a-vis the benefits payouts. Of course, that indicates clearly that there is a sustainability of the sector. When you look at the cost contributions, of course, this now kind of relates in terms of the whole year, in terms of what is spent vis-a-vis what is collected. Remember, the first was what is spent vis-a-vis what comes in as investment income. All these have been maintained at bare minimum, basically for sustainability of the sector and also enabling the accumulation of members' benefits to actually take costs significantly. Then when you look at the cost to asset, of course, this again relates in terms of what is the cost of these schemes vis-a-vis the total asset base. And maybe to state that these figures that I'm presenting are not scheme specific, but rather represent the entire sector, meaning these figures compound all the different sectors, schemes that we have on the market. Finally, I will exclusively talk about the return on investment. Of course, maybe specifically looking at 2019, return on investments, the average was 8.9. Of course, this was, it's a little bit low compared to the previous years if you looked at the 18 and the 14. But the issue of why was it low was basically because in 2019, there was a lot of issues of marking to market. That is a loss on equities, like the equities lost value. But of course, because these shares, the equity portfolio, the shares are held with a long-term kind of perspective in terms of the retirement benefit sector, because you're actually investing or holding the shares for say 15 years because that's when you anticipate that members will retire. There was no trading in terms of selling off. So the return on investment might be low, but it doesn't mean that there was a registered loss, as the return on investment being low does not directly link to it being that some shares were sold off during the period. Now, for us to consider also is that, well, you could say return on investment was 8.9, and then members always have this argument of, my money is being eaten up by inflation. That's why I indicated, just to talk in terms of 2019 alone, inflation was estimated at 2.9. This is, of course, headline. And this meant or means that the net return on investments of schemes was an average of 6%. And average interest declared to members was 9.69. If you try to take off inflation, the aspect of inflation of what may possibly eat up the value of the return, you'd have a net interest return of 6.79. That was the average for 2019. So why is this important? It answers questions around inflation. Will eat up my money? At least this should give you an element of confidence that it may not really be the case. Now, I am winding down on the sector. So I will simply share a few milestones registered in the sector. One, of course, the improved supervision of schemes, because we do off-site surveillance and on-site inspection, where the off-site looks at the statutory returns and audited accounts for any issues of non-conformance and fraud and name it. And then we've registered improved governance and administration of these different schemes. We've enhanced our capacity of trustees and service providers. Of course, trustees, these are the boards of trustees. They're the ones charged with the decision-making of the different schemes. So ideally, by the time they are able to, or they are entitled to, or tasked to actually do the decision-making, it means they must be able, in terms of capacity, to handle the technical aspects and definitely onboard service providers who they can adequately supervise. So there has been a milestone of continued capacity development in the sector of these different trustees. And of course, goes without saying, there's been increased public awareness, both in terms of the regulator, of course, much as there's still more to be done, but then there's also increased awareness around why it is important to save for retirement and about the avenues of actually taking on this saving for retirement. And of course, all the above, what are they yielding into? They're yielding into increased trust and confidence in the sector, and definitely onboarding more people, hence the increased coverage that we've seen along the years. Now, I'm done with the institutional aspects. I might have gone a little bit fast, but I knew that people would find that whole bit boring because it may not speak to you as an individual. Now, everyone that's part of this webinar possibly has a definition for what retirement is, but I know for the larger bit, many of us will talk about disengagement from active employment. And yes, I will not go into the different definitions of what it is that retirement means, but I will simply tell you that this whole thing of saving for retirement is biblical. So it has existed for way longer than most of us. I will interest us. I am a believer, so if you can go to Numbers chapter 8, verse 24 to 26, clearly you see that if I read verbatim, NIV, this applies to the Levites. A man 25 years old or more shall come to take part in the work at the tent of the meeting. Ideally, people that are aged over 25 will go and sweat, they will work. But at the age of 50, they must retire from regular service and work no longer. I mean, that's now what it is that we're talking about, that is retirement. But they may assist their brothers in performing their duties at the tent of the meeting. What basically this now tries to look at in terms of retirement is you cease being in the active engagement of retirement aspects, but you could passively engage. I mean, you could support, you could be a consultant. Then if I continued and said, this then is how you are to assign the responsibilities of the Levites. Now, what this basically means, one, they're talking about men. Of course, we all agree that men and women, same, for as long as we're referring to the Bible. We're looking at 25, but of course, this can be tailored to, I mean, working age for us is 16, but can you simply adapt and use the whole bit of you having to plan for your retirement and know that it's actually going to happen? I mean, adapt from the Bible and tailor it to yourself. Now, what are the expectations? I mean, what will change? Of course, for many, I mean, this is a boring slide because possibly you think, I mean, it's obvious, but currently you're engaged in some kind of work. I mean, what do you passively look at that will change? You have a financial compensation. I mean, that's the bank message that comes in every month and whatever allowances that come along with it. There's an aspect of time management because deep in your mind, you're used to it's 8 to 5. I mean, it's 8 to 4, it's 9 to 4, whatever the case may be. I mean, you have a sense of purpose because you have a job description. So you know your deliverables for a financial year or for a calendar year, whatever they are, to kind of define your performance. You have status because you may have your title, whatever it is. I could be a planning officer now, I could be whatever. Status. Socialization, you will, for the better part, if you did a little statistics around your phone contact and who do you keep in touch with, it's basically people within your work kind of network. So there is a lot of colleague kind of interaction, but then this will definitely not be the case as you tend into retirement, because if you looked at it, financial compensation will end. I mean, no assured income on a monthly. You look at time management, I mean, you may change your routine. You're your own boss. You decide when you leave your bed, you decide when you do what. Of course, your title may change. Others may call you Mzee, whatever the case may be. You have more time at your disposal. So the whole thing is, how do you best use your time? I mean, aspects of loneliness. And of course, just to state, you might be in the knowledge that at retirement, most retirees are in and out of hospital. I mean, they are overly sick, very oftenly sick. And that's not surprising. Many of them are not covered under any kind of medical insurance that would be an entitlement during one's work life. So what does that then tell you? It means as you try to think about retirement, can you go beyond thinking about financial aspects of retirement and also try to think in terms of diet, think in terms of exercise, and name it. I mean, that is basically just simple food for thought. Now, on this is where I'm going to a little bit go slow, just for purposes of all of us trying to get on board. I have tried to tailor a simple case, and this is trying to, I'm going to use, I decided to use the NSSF, since it's a national mandatory scheme to which over 85% of people that are covered in the sector subscribe. Now, I want you to pay very keen attention to the figures, because I'm going to use the figures at this point. And I will use 1 year. I'll talk in terms of 2019, just for purposes of getting us really very well on board. Now, of course, there is continual growth in terms of benefits paid out. Why is it so? Of course, increased interest earnings and the likes. Even if you stop saving and you're no longer subscribing, you lost your job, your money will keep accruing interest. So at whatever point that you're claiming funds, there will be growth. So there is a continued increase in terms of benefits that are paid out. But if you interest yourself in the figures, 30% of these are paid on grounds of age benefit qualification. Age benefit is basically where one attains the age of 55. I mean, they would claim their NSF benefits under the age benefits window. Then you look at 28%, that is withdrawal benefits. This is basically someone has attained 50 years of age and they're out of gainful employment. Now, these two benefits, age benefits, withdrawal benefits, are the only two benefits that tie to age. When you try to look at their proportion out of the total benefits paid out, they're only about 50%, because if you added 30 to the 28, that's about 58%. But then if you looked at the previous years, I mean, the figure is about 50%. Now, when you go to looking at exempted employee benefits, these are basically claimed by persons that join a scheme that's exempted by the ministry, by the Minister of Finance. Case in point, if someone left Stanbic Bank and joined public service pension scheme is an exempted scheme, they would actually claim their money. That's the 18%. If you looked at the invalidity benefits, are you out of employment and permanently incapacitated in that you cannot actually work anymore? You'll claim. That represents the 7%. Now, emphasis for now can be laid on the survivor's benefits. For the larger bit, people will say that I cannot hold my money with a scheme, or I'm not confident, or I'm not patient, my money being with the NSSF, because NSSF, all these schemes pay the dead. But I mean, statistically, I mean, this is not true. Only about 3% of the total benefits that are paid out are on account of death. I mean, just 3% out of the 450 billion. The 97% surviving members. Now, the immigration grant, of course, paid to persons that are permanently relocating, I mean, from the country. Now, on this slide, before I even get to my right, which has the yellow aspect, I still want to insist on my simple figures. Now, if 30 and 28 resonates around 50%, and those are the only two benefits that are tied to age. If we eliminated looking at the survivor's benefit, because that is uncontrollable, and we tried looking at the exempted employee benefits and the immigration grant, I mean, one would ask, you are getting these benefits. If I am sweet 16, okay, if I'm 18 now and I'm moving from Stanbic, I'm going to public service, and I'm getting my benefits from the NSSF, not just benefits, but I'm getting my retirement benefits from the NSSF, one would ask, is that retirement? I mean, what is in it for you? I mean, what's the justification of you going for them then? So that poses in an issue of preservation of benefits. That is pre-retirement preservation of benefits, where instead of you accessing your money, can't you leave it to grow, to serve the purpose for which you decided to put it aside? Of course, that would go down to immigration grant. Ask yourself the same question. I mean, is it really retirement that you're going for? Are you being truthful and getting the monies for the purposes for which you put them aside? Now, beyond looking at the money, because one will always tell you that, well, I have my 10 million sitting with the NSSF, or I lost my job 7 years ago. I mean, my money is sitting with the NSSF. What does again statistics show? I mean, what do the figures show? If you tried looking at on average of the total benefits that are paid out, take a case 2019, 450 billion. Now, if you went down to kind of disintegrate this figure to see what is it that one is overly saying that I painfully put aside, you will be surprised. Of the total accumulated figures, only 8% of the total saving of the total benefit paid out is on account of employee benefits. That is employee contributions. 16% employer. 76% is on account of interest earnings. What does it mean? For example, I will use a very simple case of a person that saves for 5 years and unfortunately maybe gets off out of employment and maybe save for 10 years. 10 years down the road, if you ran this person's statement or tried to review this person's statement, what's the total of the total amount? What is accounted for in terms of the 5% that he was sending to the scheme on a monthly? Will only be about 8%. And then the employer 16, majority, which is the chunk of this money, is on account of investment earnings, that is from investing the funds for these different members. So does that then leave you thinking that, okay, fine, if my contribution is 5%, which in the end is on account of about 8%, can't I do better with the little trivial money that I may remain with after deducting this contribution to the fund? Now, further then, if you looked at an early start and how adequate are your benefits, same case, if at all 76% of your benefits are on account of investment earnings, what does it then mean for you? It ideally means if you started early, you have chances of your funds growing way faster, because especially considering that interest earnings and interest declared to members is on account of a previous accounting period. So whatever you accumulate along the way will further accumulate significantly and further, and the trend will continue. So is it an early start for you, just so you ensure that you're able to get adequate benefits? And of course, this is on a very key assumption that you will not disrupt the accumulation phase. You will not go for exempted employee benefits. I mean, you will not go for immigration grant. Basically, you will not, I mean, it even gets worse if we looked at the arrangement that we call the supplementary occupational schemes or individual schemes, because you will find that I will belong to a supplementary occupational scheme of, say, Absa Bank, staff retirement benefit scheme. And then along the way, I change employer and I go to Bank of Uganda. I mean, as I'm leaving Stanbic Bank, I claim my benefits from the Stanbic Bank scheme. I mean, but it's a retirement benefit scheme. But of course, you are taking out your money on course of change of job, not for retirement, but they are retirement benefits. So as you think about the early start and you think about how adequate are your accumulations for old age, you ought to think in terms of how best can you try not to interrupt the accumulation phase. Now, very important as well is from my aspect of saying, can you think of retirement beyond simply the money? That's where I will task you to think in terms of diversification of your money. It's not that all your money should be held in the retirement benefit sector. That what comes to the retirement benefit sector before retirement, and then go a milestone. I mean, lately you find that there are a lot of people that tie planning for their retirement around educating their children. So if it's the case, can you take out some of this money and maybe buy an insurance product that will educate, say, your child or something? I mean, further with diversification, can you participate in a circle so that if you have a very short-term need, if you have an emergency, if you have, you quickly run and have some kind of bailout, it may look little in terms of what you put aside. It could be, I mean, I will not say amounts, but you might see it as little when you start putting it aside. But the pace at which it accumulates, irrespective of the arrangement, you will be shocked at how it meets you halfway or fully when you have an issue. Now, I will quickly go to my right. Now, putting aside whatever figures I've presented that are basically based on the scheme level performances, I want to share with you a little in terms of what we found out from the study that we undertook as UBRA. We did a study that aimed at unveiling the attitudes, level of knowledge and preferences around sector participants in terms of course, we asked so many things around convenience, I mean, whatever the case was, but I will share with you something that I think is relevant for now. Now, one, you will appreciate with me that the case I chose, which is of course familiar to all of us, is a provident fund. By provident fund, I mean, it pays you lump sum. For as long as you qualify, you draw a lump sum. What does that mean? Post-retirement preservation of funds is lacking, because maybe one would expect that this money should, take you through your old age. I mean, is it the case that you should get bit by bit, maybe on a monthly or whatever the case may be, so that it serves the purpose? But this is gotten in a lump sum. And then when one gets it as a lump sum, what do they do with it? Now, upon seeking responses on, of course, a multi-choice kind of response, we established that 77% of retirees state that when they get the NSF funds, they are still mandated, of course, having school-going children. So they divert some of that money into school fees. Many others are buying land, others are constructing houses. And the funny bit is you buy land, start constructing the house. A quarter way into the project, the funds are done. So you're left with no retirement benefits. You didn't meet the objective of you having land or you having a house, or you get into a business project. And what does it mean for you? I mean, it's an aspect that maybe you do not have experience about. You've been a former worker, you're going into rearing chicken. I mean, and you're very green about the whole thing. I mean, whatever the case may be, risks and rewards is what I'm trying to point out here for basically the aspect of businesses. But then, of course, when you also look at the aspect of paying school fees and building a house, of course, these are some of the aspects that one would wonder, like, can't you try to think in terms of how do you meet these during your active term? Paying school fees, can't you buy an insurance product for your children? That is why I talked of the diversification. Building a house, I mean, of course, I will share development that along the way, there is consideration that possibly it's about the time that there should be a window for access or attachment of retirement benefits to, say, mortgage and health and whatever the case may be. So that may cure that. But then for aspects where you can diversify and go beyond your means, I mean, do it. If I proceed, I now go back a little to sector priorities. And of course, to state that in all the priorities that are geared up for the sector, they are all aimed at ensuring that there is security in the sector, that the retirement benefits accumulated by members are adequate enough to meet their old age needs, that there is sustainability, like you shouldn't be worried of the wind up or whatever the case may be, and there is stability, that is in terms of the continued healthy operation of the sector, where, for example, the benefits should not surpass the contributions, and to mention but a few. So amongst our very key priorities in the sector now is intensification of supervision of licensed entities. That's basically the schemes and service providers, because these definitely play a very big role when it comes to the accumulation phase. The decisions they make and the different activities they take on determine what your accumulation phase will be like. And like we saw, 76% of your benefits will be on account of investment earnings. The other very key priority is in enhancing the investment in risk-based supervision. Of course, the system is supposed to enable attainment of real-time information by us, the regulator, so that we're able to move in time in case of any anomaly on the sector. The other aspect is increasing coverage of formal sector workers. Taking you back to my general statistics, we shared that about 15.3 what is the number that is currently employed. But of the 15.3, about 3 million is what is in the formal sector. But then if you go further to the formal sector, you'll find restrictions. So the NSSF only mandatorily covers employers that have above 5 employees. I mean, so you find that there is a lot of people that are involved in the formal sector engagements that are left out. So one of the priorities is to increase coverage to the formal sector workers. The other is extending coverage to the informal sector. And like I stated, of the 15.3, over 80% in the informal sector, so 12 million of Ugandans are employed in the informal sector. I mean, and those currently in the existing regulatory framework, these are not taken care of. The other is to reduce operational costs and encourage additional savings. Operational costs and the whole bit of supervision will go hand in hand, because with good supervision, by default, the operational costs will come down. For as long as our different trustees and service providers have the capacity and they are well certified and trained, the operational costs will definitely go down. But then we're also looking at, can we encourage additional savings? Can you go beyond what you're mandatorily putting aside? Can you go beyond the 5% that is deducted at source? And also, I mean, do an additional. Can you subscribe to any of these voluntary schemes? Are you an employer? Can you consider the new trend of motivation and retention of staff that hangs around having a retirement benefit scheme? That's basically one of the priorities for the sector as well. We're looking at promoting preservation of pre- and post-retirement incomes. And of course, this answers the question of you're moving between schemes and drawing your money as though you're retiring, yet you're simply changing jobs. Post-retirement, we're looking at you are accessing your money you're getting your money from the NSSF as a lump sum. Can there be a window that you can elect to say, no, I will draw down my income, just so you're sure you will not waste it and it will serve the purpose for old age. The other priority is permitting partial accessibility for special considerations. Of course, this is an aspect that I think members might be largely interested in. The special considerations might be health, might be a mortgage, might be, acquisition of houses. But beyond interesting you and giving you the excitement that this is a priority, can you also think in terms of, if it comes to pass, that it's passed and it's into law and you can actually access these, will you benefit? For example, assume with whatever balance you have with, say, the NSSF, assume you're permitted to access or assign about 30% of your total saving for maybe acquisition of a house. Ask yourself, like 30%, if you have whatever you have, say 50 million, say 20 million, where 30%, can that actually get you any mortgage on the market? What all this means is, if you want to benefit from some of these aspects, you have to try to make sure that you do additional savings, accumulate your funds as much as possible, because accumulated funds will in the end give you a higher kind of security, if I may call it. The other is to facilitate sector reform proposals. Of course, this directly falls in our mandate as a priority, because should there be any cases of we want any reform in the sector, should it be with the NSSF, should it be with the public service pension scheme and the likes, we are supposed to facilitate and give technical advice. Now, from the priorities, what's the way forward for the better bit? Whatever we are doing now, whatever we are changing in the sector now is hinged on a few, what I would call guiding principles and what we've seen as a way forward. One, informal sector, currently very left out in terms of the regulatory framework. So we're working so quick to come up with a sound regulatory framework for the informal sector. And to date, we have regulations, but not yet enacted, they're still under internal review. Then we have gone ahead to implement a trustee certification program. Of course, this has been in collaboration with the Insurance Training College. This is going to facilitate development of capacity of trustees and the different service providers on the market. And what this will play out of is technical aspects will be well comprehended when it comes to service provider performance appraisals. I mean, this will be very well done and grounded in terms of, because one knows what exactly it is that they have to look out for. Now, beyond simply coming up with a regulatory framework, we have to, I mean, we're looking at implementing a strategy that's going to look at extending coverage to the informal sector. The strategy is beyond the regulation, but it taps into coming up with appropriate products, coming up with, of course, and looking at products, you're looking at the density and the frequency of contributions, you're looking at convenience of enrollment and participation, and name it. So, I mean, you're looking at awareness and instilling, confidence, getting to know the avenues. I mean, the strategy tries to take care of all that. Then in a bid to leverage technology and reduce costs of doing business, we're looking at a system that will help the efficient operation and management of different records in the sector, vis-a-vis upgrading the supervision system to permit real-time information, like I stated before. And we continue to engage all the different sector stakeholders in aspects that require policy and reform around the retirement benefit sector. And of course, all these are on the basis of ensuring that there is adequacy, security, and sustainability in the sector. Now, finally, on what's also guiding is an issue of incentives. Of course, incentives, you can look at them from the financial and non-financial arm. And what's guiding us so much as we try to roll out whatever it is the financial end. We're trying to look at aspects of, is it possible to get to a position where there are cases of co-contribution, where we're saying, okay, contribute this much and you're met halfway. Maybe subscribe to a scheme and you contribute 5 and the employer will definitely give you the 5, that kind of matching and co-contribution. And when we look at the non-financial incentives, I mean, these beyond leveraging technology and aspects of convenience and ease of contribution and participation, it goes beyond to look at aspects of, I mean, what are you doing now to entice people that you're sound? What are you doing now to entice people and people to get to know that they will actually be paid? And broadly, as a regulator, protecting members' interests, we aim to also show that we are trying to ensure that there is a leveled ground towards a very sustainable retirement benefits sector. Now, still, I'm moving away from the sector aspects, and these are what I would call a little take home for us. One, of course, you may know, or you may want to appreciate that moving from active employment to retirement is change in itself. And Billy Crystal clearly stated that change is such hard work. Of course, why? It comes with stress. I mean, it comes with anxiety. It comes with whatever it is that you actually had not prepared for, yet you had a lot of time to prepare for the same. But very key to note is on bullet 3, where I want to emphasize that retirement planning arrangements, that's basically the different scheme arrangements, the different tiers that I shared, should be looked at as vehicles, one, for mitigating against old age poverty. And if you agree with me on this, then you will try to ensure that you preserve your benefits both pre and post. The other is you should know that these plan arrangements and are supposed to enable consumption smoothing. Of course, this is being able to meet your costs as and when they fall due during your retirement. And then I want to remind each one of us that the risk of outliving our savings, that's basically the savings running to zero before, you leave the earth, is real. So you have to start planning early so that your benefits are able to accumulate. Remember the 78%? I'll keep reminding you of that. So they will grow, accounted for by the 76%. So if you can start early, the accumulation is faster, and definitely you gain lots. Well, think about it. Is it that you want to continue looking for employment even in old age? Do you want to fall in the category of the 66.3% that I shared under my statistics of persons that are over 65 but are still looking for jobs? Or do you want to actually be so much on holiday and enjoy your retirement? Those are questions that you may want to ask yourself now to guide your retirement planning. I thank you so much for listening. I am sure we are now going to have a very much more productive engagement.
Wow. Thank you so much, Martin. I must say from my side that part of my worries have been addressed. To be honest, from the interactions we're having, some of the people really fear retiring. That's why you hear most of the people, my dad used to tell me some people who could come to their bosses when they are already 55, he's trying to ask, in 60s actually, he's trying to ask for a renewal of the contract. Say, at least give me more 2 years. So that's why actually it comes with some worries. Give me more 2 years, give me more 1 year, or even 6 months. So really, I believe that every person has picked a word or two. And from this side, we are going to have a poll, and I request every person to participate in this poll so that we can really paint a picture of the audience that we have, and get to give as well the discussant a picture of what sort of engagement should we expect following another segment. We are going into of questions, Q&A. Feel free to drop in your question here. We have a Q&A. We have a Q&A provision here where you can put your questions or compliments or any other thing that you would want to know about this webinar. So we have a Q&A provision, so you would really have an opportunity to put in your question or any other compliment that you need to know regarding this topic. I must remind you that today's topic is early planning for your happy retirement, and for those who joined in late, we are being facilitated by one from Uganda Retirement Benefits Regulatory Authority, that's Mr. Tugume Martin, who has given an insightful presentation regarding retirement, why someone should plan for a retirement, and the pictures we also at the end of the presentation can really ring a lot into our minds, and we have to draw a lot of conclusions from those pictures. Maybe Martin, you can take us through the polls, so that you can have a feeling, you can have a sense of the people we're interacting with, and what are their interests and what are their takes regarding this topic. Thank you.
Well,
can you see the poll, Martin?
Yes, Benedict. Our poll results, in terms of age, I think it's a good thing that, of course, we do not have anyone below 25, but 30% are aged 25 to 35, and 36 to 45 is 33%, and over 37 is 46. So I think this is good enough. We are still in for the early planning. Then in terms of belonging to the schemes, 78% of our audience belongs to the NSSF. And in addition, 11% subscribe to work-based retirement benefit schemes. Then we have 7% who are in voluntary private schemes. And we have a 4% who are not anywhere. Okay. Do you have a solid plan for your retirement benefit? One, yes, in my head, 56%. Yes, undocumented, 15%. No, 30%. Okay. at what age do you want to retire? For the better bit, most persons are stating 51 to 60 years. But of course, we have those that are saying, I mean, they want to retire over 60 years. I don't know whether I can actually react to some of these questions before we can, I mean, some of the results before we can take questions. Benedict, I hope I'm fine.
Yeah, sure. Feel free, Martin. Please.
Yes, now, for starters, it's a good thing that majority of our respondents are actually saving. That is mandatory with the NSSF, but of course, this is a deduction that's made at source. So I may not get so excited and state that they are willingly saving. It's mandatory anyway. But we have 11% that are in mandatory, I mean, in work-based schemes, mandatory at that. And then now, when I look at the 4%, which is none, I mean, I'm thinking like this presentation should actually speak to you, because what is it that you're thinking of in terms of your retirement? And I'm only hoping that this 4% does not fall in those aged over 46 years, because I mean, I wouldn't want to say that you're a little bit late to think about your retirement, but I would only get worried that time is running out for you. Now, when I try to look at issues around the retirement plan and what it is that, I mean, you have as planned for your benefits, you will state that for the better bit, 56% of our participants have these plans, and they say they are solid, but in their heads, I mean, by them being solid, and then you say they're in your head. I actually believe by the time a plan is still in your head, to the larger bit, it's really not as solid as I would expect. It would actually simply mean you're still at the phase of trying to assess the different kind of planned, say, investment vehicles or whatever that you'd want to consider. And fellow participants, what I would want to encourage you is, I mean, if you went down to, you receive a lump sum, say if you're with the NSF, receive your lump sum, and you have a plan in your head, and someone comes through and said, because ideally, you know, there is an aspect of the higher the return, the higher the risk. A person will come and easily play around with your mind in terms of a Ponzi scheme, in terms of, I mean, a seemingly rosy business, and you will fall for it. I mean, ideally, because as long as a plan is in your head, I mean, it simply states that you have not done adequate kind of analysis in terms of cost benefit and risk analysis around the same. So I would encourage you to consider taking a little, I mean, further steps, especially for those that are like, say, tending towards your retirement. If you're 10 years away, can you try to document your plan? I mean, so that if you're evaluating whether your plan is on course, you have some kind of baseline data that you will compare with in terms of your assessment. And then looking at when is it that you really want to retire? I usually want to encourage people, I mean, at whatever age, I mean, I also encourage myself to try working like as though you are going to get out of the job market now. I mean, you shouldn't be pushed out either due to redundancy or whatever the case may be, and you get into a panic mode. So it's always good if you have your set retirement age to be as close to you as possible, just so it gives you more kind of zeal and focus to better diversify your different investment vehicles towards retirement, and of course, accordingly, have a very Zabu kind of retirement. Now, if you're looking at retiring at over 60 years, I mean, it clearly means if something happened to, I mean, you and your job employment at about 50, I mean, because of the stress and the related shocks and the likes, I do not know whether the average of life expectancy in retirement at 17 would really be below or high for you, but to the larger bit, I would think, of course, shocks and, you know, the stress, these are elements that will kind of limit your health and definitely reduce your life expectancy during retirement. I thank you. Benedict, you can proceed.
Oh, thank you, Martin. And I think most of us at least have painted a picture. And again, Martin, I have to thank you for the further enlightenments that you put to this poll. Especially the one bit that I pick is to encourage most of us to retire as soon as we can, okay? So that at any point, you must have it in your mind that you can exit that job by whichever forces. because we've seen quite a number of things coming in, some of the natural calamities and other things that may not be planned, whereas you may be planning to retire after 10 years, there is a force that can direct you to retirement of 7 years down the job, which I had planned to do for close to 20 years or plus. So that is something that we all pick. And maybe to have a few questions that we can pose to Martin and to put more relevance to this topic, I must imagine that some people must be there wondering and asking themselves the same questions. You talked about the other 4% in the poll. These people who are, I mean, call them those are in the informal sector. Okay, so at Ulbra, or any other retirement benefits or any other retirement schemes, call them so. What are some of the interventions are you putting in place to tap into the other percentage? Of course, you've talked of some forthcoming initiatives like having an establishment of the Act of Parliament so that you can cater for those people. But as of now, if someone comes like a mama who has a mudala downtown in St. Valley Kudebe, and maybe they have gotten to take the message of this call, what would you advise them, or how would you treat them? Do you have a product that can fit into their demands? Can you have something that you can offer them and regarding planning for retirement? Because whereas most of the people have a feeling that uh, money comes and goes. Some African people put that saying, which I believe it also goes back to the planning and all that. If someone has planned well and planned his retirements, I don't think such sayings will be coming around. So I have to believe that it rotates around planning. So what are some of the initiatives do you have in place as of now? Or what are some of the products do you have that can suit such people, the other people who are in the informal sector? Because you've seen the hugest percentage is savings the NSSF.
Yes.
But bearing in mind that this campaign is a nationwide campaign and it is targeting every person, the ones who is on the Mudala, the middle level class, the corporates, the elites, the retired, and every person, we have a call for him to join this campaign. So just throw more light on this informal sector. What do you have in place for them at Ubra and then you as a regulator? Thank you.
Well, looking at the informal sector, I will start from where we started from as the authority. We've undertaken a number of studies that, of course, are aimed at trying to inform the products and policy formulations that we have around the informal sector. And from the many studies, we have moved to coming up with a draft regulation. It will be a regulation, not an act. So you shouldn't expect it to take as long. Now, beyond the act, I mean, as you wait for the act, what can you do now? I would want to inform us that currently we have 2 licensed supplementary voluntary schemes, those that you can join in now as an informal sector person. One is the Kasita Provident Fund. Of course, this takes care of the persons that are members of the Kasita Association. And then the other is the Mazima Voluntary Retirement Benefit Scheme. This, any person can actually subscribe to this scheme. But beyond the 2, which are really, I mean, individually tailored as per se, I would want to interest members in the voluntary plan arrangement of the NSSF. If you are an employer and you have less than 5, can you tap into the voluntary plan of the NSSF? If you are formally contributing monetarily to the NSSF and maybe you now moved into the informal sector, can you make voluntary contributions to the NSSF? But that aside, I mean, from the tier that I shared, the tier 4 of the supplementary schemes, now these schemes operate as either segregated, others are umbrellas. And I would want to state that the umbrellas we have on the market have a voluntary plan kind of product. So if you feel like you want to subscribe to any, I mean, it's simple. Reach us as the authority, which we'll try to, of course, share in terms of how much are you looking at in terms of putting aside, and the amount will inform what kind of scheme that you could consider joining. But to answer you directly, yes, there are currently arrangements where you can start with as low as 2,000 each time you're remitting to whatever ceiling that you have.
Thank you, Martin. I must say that personally, I didn't know about such schemes, so it's good that we are bringing out such insights. And going into the members' questions, those people who have been interacting with us in the Q&A provision, we have Ronald Isiko saying, thanks, Martin, for the presentation. My question is, what is the procedure for pursuing an employer who did not remit my NSSF or any retirement benefits?
Well,
I think I should have kept that name anonymous. I think he's bringing out something. What would be the procedure?
well, of course, the name is fine because I believe he could for someone else. So maybe to answer him, yes, Isiko. Now, of course, on the market today, even when you try to look at the NSF compliance figures, it clearly shows there are those employers who are supposed to be compliant, but they are not. They have beyond 5 people, but they are not registered with the NSF. They are not contributing. How do you handle those? Simple, whistleblow. There is a whistleblower platform on the NSF website. You can actually report them, and your details and credentials will be left confidential. Then there is also another phase of where, for example, say Ronald was working with an employer, but then upon leaving and joining another employer, that's when he notices like the previous employer was not remitting their NSSF. How do you handle that? Still, it's a simple one. Look for proof that shows that you actually engaged with this employer. I mean, do you have an appointment letter? Do you have what shows that they were actually in some kind of contract with you that they were supposed to remit for you? So with that kind of proof, still you can whistleblow. And you can still try to, I mean, you could consider raising a complaint. For example, if you whistleblow to NSSF and you think like, I mean, you're not satisfied with their kind of action or their response, log on to the UBRA website, file a complaint. We have a complaints window on our website. That is www.ubra.go.ug. So you can lodge a complaint and we'll definitely follow it up.
Okay, thank you. And I guess the gentleman who raised that issue has been well noted. Just to resound on that, they are official whistleblowing channels. You can check out on the NSSF website, the NSSF branches, wherever you enter, they have those boards in the branches. You use the official lines for whistleblowing, then your money will be remitted back. That's the right way to follow up. Martin, maybe one wonders if I'm 40, 45, and maybe I've been in the informal sector, the other 4% you've been talking about. Is there any such a time that it is really late for me to start my journey of retirement, the planning for retirement, or what are some of the quick bites would you give this person? Would you give me if I'm 45, 46, and probably this individual has not been remitting his NSSA, voluntary schemes, and any other voluntary saving schemes? What would be what advice would you package for this individual? Is it too late to start? And if he's to start, how can he start? And what are some of the quick takeaways you could look at? Thank you.
Benedict, I would actually state that it might be somewhat late, but it's never too late. So for a person that's 45 and over, for starters, the good thing is that if you looked at the NSF Act, or if you looked at these different scheme arrangements, you can be a member for as long as you're below 60 years. So if you're 45, you can still enroll. You can get enrolled with the NSF. You can get enrolled with any of these other schemes on the market. And what then may change is, you know, when you're doing your retirement planning, it begins with a self kind of assessment. Know yourself, map out what you actually want to be like, I mean, in retirement, and try to work towards that. For my plans, if I am 18 today and I'm planning for my retirement, my plans will be so big in that I will have a target in terms of accumulating to meet the big plans. Whereas for someone that starts and they are 45, ideally you may have to tone down in terms of what it is that you want to be like in retirement. So that whatever the target is, I mean, something that you can work on given your 15 years of employment. Benedict?
Sure. Thank you. Thank you so much, Martin. And if to take you back to part of your presentation, you mentioned earlier that many retirees are in and out of the hospital. Most of them, after they have gotten into that retirement age, that's when they have ceased to get the insurance cover from their employers, and this time, most of them they have just gotten their monies, and it actually looks like the diseases that really have to make them go in and out of the hospital are not necessarily like real diseases to be diagnosed. They come out of fatigue, maybe the routine they are not used to. Someone has been used to waking up in the morning, going to office, but this time he has to wake up, probably look at the veranda or go at a balcony if he has one. So, what are some of the quick takeaways you could give these people in such a bracket to avoid such kind of situations so that they can keep fit, strong, and have an engaged mind, or to avoid such diseases? Because it just like you mentioned, I also have to resound that these diseases are not diagnosed. The diseases that someone will go to the hospital and they diagnose. You find these diseases actually come out of such situations that they are not used to. So what are some of the advice that you give these people as they retire so that they can avoid such kind of situations?
Well, for starters, the quick wins are two. One, you have to ensure that you eat well. But what does it take for you to eat well? Save now so that you can afford a good meal, a balanced diet for yourself. Two, I mean, it costs you nothing to do workouts. So every evening you do some kind of workout. Can you keep your body warm and up to the task? And then finally, one aspect that I will actually state is during your working life, you actually get to feel like you have a hobby. You may find a Benedict here who may so much want to talk to people, to present and the likes. Can't you volunteer and, become like a focal person of sorts in whatever field you choose? But then lastly, and most importantly, there is a continued drive of you trying to ensure that you join associations. There could be, for example, Rotaries around your neighborhood. You could join, it could be a church kind of, join an engagement that gives you some kind of sense of belonging, that gives you an element of having to work towards a given timeline or deliverable so that you keep your full body working.
Thank you, Martin. That poses another question. You at Ulbra or any other one of these retirement benefits schemes that you are overseeing, regulating. Do you have some of the measures or some of the clubs that you put in place, or it's about retiring, you save your money, we give you your money, you go? What do you have some of the associations or some of the initiatives that you have to bring such people to such kind of life so that you can maintain them through a retirement as they adapt to that life? Because someone who has been used to this kind of work for over 40 years, it's not easy. And then if it is to give him the money, take your money, go, but possibly the relationship has ended. Is that how it is, or there is that continuous renewed relationship that you remain with these people? Do you have a policy that speaks to such?
Well, in our operations as the regulator, for starters, we hold pre-retirement engagements, where from amongst our existing schemes, we sieve out people that are left with, say, about 5 to 0 years to retirement. And we engage these persons and tell them what retirement is, and what they need to prepare to be sure that they can actually live a Zabo kind of retirement. But then beyond that, different districts in the country, I must report that they have associations of old persons. You'll find that they often meet, discuss, because these have the same kind of cross-cutting issues. So often we do this district courtesy visits, and we engage with these associations just to keep them abreast in terms of what it is that they have to keep mindful about to ensure that they live longer in their retirement.
That's good. That's really good. It's really good that you keep that prolonged relationship with them, and I'm pretty sure that most of them really actually do a happy retirement. We go into the Q&A where some members have posted their questions. We have Joanne Katshabe. She has been very attentive. She has been paying serious attention, and I think she noticed something behind on your presentation about Zab Life. So she's asking, tell me more about Zab Life.
Well, this is a very
It's a very
interesting
brief question and very brief, and I'm also looking forward to hear about
No,
Zab
it
Life.
actually, it speaks volumes. You know, when we ran an awareness campaign, specifically if you looked at the flyer that I posted, it was a Zabu Life campaign. Zabu Life meaning like gold life, Zabu, gold life. So, I mean, majority of the people in the public got to think like maybe Zabu Life is a scheme of sorts. But no, Zabu Life is not a scheme. It was simply an awareness campaign that was aimed at trying to awaken persons to contribute, to participate in the different existing schemes that are regulated by UBRA so that they're actually able to attain Zabu Life. So that's what exactly Zabu Life is.
Sure. Okay, thank you. And I believe, could it be on anywhere near websites or any portals that someone can access and get more detailed information?
Specifically, well, on our website, you're able to get information about whatever service providers that are licensed in the sector. I mean, just to be sure that you're dealing with the right persons. But then we also overly encourage persons that should you have any questions, feel free to dial us up. I mean, we're actually on social media, we're also not being left behind by social media engagement. So you can hit us up on Twitter, you can, I mean, feel free to ask whatever it is that you want to know about us.
Okay, thank you, Martin. As you go on, I've been running, you talked of awareness campaign, just like you run the Zab Life, you're also running the Banking and Financial Services Awareness Month, where we are targeting all sorts of people in the entire community, in the entire public. We are targeting them to be aware and get to know some of the services that are offered in the banking and financial services industry, and on this, and plus not only actually in the banking sector, but other players in the financial services industry. Where we've had insurance will be coming up. Tomorrow we'll be having speakers on insurance. That's why you see now we are having the retirement benefit scheme also coming on board. We've had talks about savings. We've had talks about investment, personal financial management, and this brings me to another question, Martin, where I've been talking about, we've had talks investment, just like I've said briefly, just a while ago. So when it comes to investments, what are some of the, because you know, these people, when they retire, they usually get a huge chunk of money. Someone has retired, possibly has gotten a chunk of 500 million. I've seen others who got as much as 800 million. And the fact that is some of these people have been used to the work, it is so informal office work, and most of the stories we've seen, people talk about investment in agriculture, investment in real estate, and even other some contemporary modes of investment. So from my experience, based on some of the retirees we've interacted with, what are those most genuine and most attainable investment ventures we should advise someone to invest their monies in after they have struggled for all these 30, 40 years, others even work for 35 years plus, and they've gotten this chunk of money? What are some of the key investment ventures you would advise these people to invest their monies in? And possibly, what are some of the most viable channels would they go to seek for better investment advisory services so that they can put their monies that they have worked for the rest of their lives to use, and they have a happy retirement? Just quickly highlight on some of those investment channels that you really encourage these retirees to invest their monies in.
Well, for someone that has not been involved in agriculture, not in real estate, I definitely wouldn't encourage one to attempt starting these in retirement. To me, they will be very high risk for them. Now, an aspect that one may consider is venturing into fixed incomes. Can you do fixed deposits? Can you buy treasury bills? Yes, of course, one may argue that the returns may not be as good on this, but at least you also know that the return goes hand in hand with the risk. And at retirement, I don't think your risk appetite should really be very high, because you will stand chance of losing it all. But then beyond this, in terms of investment avenues, if I was a Martin that's retiring now, and I don't have a clear plan for semi-funds, say NSSF. I don't see what's wrong with me first leaving this money with the NSSF, because if you looked at the financial market in terms of the returns on investment, you will find, for example, if you do maybe treasury bills or bonds, you may get 10% return. But if you looked at the average in terms of these schemes and what you get back in terms of the return, it is, I think, the best that you can have on the market. The best is around the retirement benefit schemes. So me, I would rather leave the money in the scheme, try to come up with a concrete plan, and then draw it when you have a clear plan. But further to this, I mean, one of our priorities, as said, is to try coming up with a post-retirement kind of preservation, where if, I mean, you may elect to only access a portion of your money so that you don't take the whole lump sum. So you choose and say, I will take 40% as a lump sum, and then the 60% can first stay, and then maybe you get it in bits. I mean, that would still be wiser. At least it would mitigate the old age poverty.
Sure. Thank you so much, Martin. I think that speaks to so many, because unless someone has been having a past experience in these investments like agriculture and real estate, but if you've not been having such kind of expertise, I think we've all heard from Martin, fixed incomes will be the best option. And of late, we have had a talk, that was a webinar facilitated by Paulo Katongole from Bank of Africa about some of the investment options that can be accessed from time to time. Moving on, we have Madam Joan Katushabe. She's saying, how does one compensate for the devaluation of money? Does one save more to compensate for future predicted inflation? That's Joan. I think she was deriving from your presentation, where there was some element of some currencies devalued, having a devalued rate, and then at the end of the day, the interest which is given doesn't match what they're expecting to get after the period of saving. What can you have to say about that?
Well, I think Joan must have missed my presentation where I tried moving from the return to investment to the net return after taking out inflation. And then I looked at the return, I mean the interest returns, and then looked at the net return after taking out the inflation. At that point, I made it very clear that you need not worry that, because if I may refer, just to be sure that I don't project again, I looked at 2019, where I said that the interest for 2019 was 2.9. And then when you look at the net, the return on investment for the sector, it was at 8.9. So if you do a net, that is the return on investment, take out the inflation, it would be a return of 6%. Now, on the other hand, when you look at the average interest rate that was given by the different schemes to the members, this was 9.69. But then if you take out the inflation of 2.9, you still remain with earned interest of 6.78. So it's not that the inflation is eating up onto your funds. No, that is not the case, but rather the return you get will, I mean, ably over the years, it has been able to more than surpass the inflation rates. So Benedict. I think as we wait for Benedict, I will try to also respond to something that came from Alex.
Yeah, sure. You can go ahead.
Yes, and Alex is asking why is the sector not liberalized well? Maybe, of course, Alex, I don't know whether he's aware, but there was a retirement benefit sector liberalization bill of 2011, which was tabled before Parliament. But to date, the sector is not liberalized, largely because this bill was never passed into law, but it was rather withdrawn for further stakeholder consultations. So until the bill on liberalization is passed, is only when the sector will actually be liberalized.
Okay, and, thank you.
And furthermore, I also still want to react to Alex. He's actually looking at the statistics shown in terms of, from the study we did, what people actually use their lump sum for, and he's looking at the 77% of the retirees that use, yes, like I stated, of course, those were multi-choice questions. So you'll find that, I mean, out of the 100% that were asked, 77% had an element of still paying school fees. I don't know whether this would mean that for one to, I mean, as you take on the course of planning for retirement, I don't know whether it should stem from your family planning in terms of you having to work fast in some of the biological aspects. But that is an issue for one to think about. But then it also causes thoughts around diversification in terms of, can you get an education product for your children where you would continue making nominal contributions. And I think this is an aspect that members should interest themselves in, especially the presentation coming through tomorrow. Because like I stated, you can put aside as little as 100,000 per month. But then if you put it, I mean, if you save this over a period of say 10 years or 5 years when you expect your little one to join secondary, this amount will actually be enough to take them through the whole secondary life. So an aspect of diversification as you plan for your retirement is a must consideration.
Right, thank you. We could pick a few questions maybe from the chat room. We have Sechiwanzi Brian. He's saying, how would you advise someone who has worked in a foreign country on a way to gain access to their social security benefits and have them transferred to their country of origin? Is this a case in Uganda? Thank you.
Brian, thank you so much for your question. Now, Brian's question resonates around the issue of preservation, where I was looking at, instead of you accessing, say, immigration grant from the NSSF, can this be transferred if you're relocating permanently to Kenya? Can this be moved? Well, to state that currently there is no regulatory framework that actually would enable that, but it's one of our very key priority areas, and already the regulations we have in-house in draft permit for portability of funds. And this is going to be possible once these are enacted. So yes, it will be possible for one to move with their benefits around the region, basically. So, but for now, it is not permissible, but it will be as a priority area.
Okay, thank you, Martin. Maybe as we try to wind up, what advice would you give to some people, possibly those who have been earning some good money and they reach a time of retirement, they have left their jobs, and maybe they really want to, they don't wish to withdraw their monies from their particular schemes they have been saving with. Give an example of Oprah and some of the schemes that you supervise. What some of the measures that they have in place? Would they give them another rate, or they would continue giving them a savers rate?
Well, the rate is given to, of course, now what determines that one is a scheme member? You're a scheme member, whether, I mean, by registration, whether you have some periods of inactivity accruing out of the fact that you're not able to make a periodic contribution, say you lost your job along the way. I mean, the rate that is given to me, who is actively saving, will be the same rate that's given to you. But remember, this rate is applied to, it's applied to the amount on your account that was used for investment. So if, you had 10 million in there, the rate is 10%, of course, it will be 10% of your 10 million, that's 100,000 that will be given to you. So the rate is standard for all members, and all members basically means active or inactive. That's why I stated that leaving your money in there is not of any harm, but in any case would ease your kind of growth in terms of your money growing further, especially considering that the interest is applied on a closing sum that was invested.
Thank you, Martin. Thank you. I must say that this has been so insightful, and the people out there.
Benedict, we've lost you.
Yes, Martin, I was saying, thank you. It has been so insightful for the people who have been looking forward for this webinar. And I must say that we've gotten the best from the best. And as we conclude, what are some of the key parting shots would you give to our listeners this afternoon as we conclude?
Well, in conclusion, I would want to start by appreciating the Institute of Bankers and Financial Services. Of course, in our market today, there is a lot of limited awareness about issues around finance. Actually, to the better bit, many people try to avoid this topic because they think they'll always be got to on the negative side of what they think, they should be doing. Possibly meaning to the larger bit, most of us are doing things the wrong way and you do not want to be corrected. So first, I applaud the Institute. Thank you so much for this engagement. And to my listeners, I think I will use myself as an example. Please diversify. Have save your money with the NSSF. Have an occupational scheme. You can enroll in an individual scheme. Buy an insurance product for your children. Basically, with the diversification, your retirement will surely be Zabu. Thank you so much, Benedict.
And thank you so much. On behalf of the Ghana Institute of Banking and Financial Services, I need to thank you, Martin, for making off this time to come and share your knowledge with us. It has been really insightful, and I believe everyone who has tuned in has really benefited a lot. And I must remind you that we are running this series of webinars. Tomorrow we shall be having another webinar about insurance and enabler for business growth and continuity. We are looking on how best can we embrace insurance and move forward, especially to guard ourselves against some of these calamities that hit us. Must mention that this month is being sponsored by quite a number of institutions that have brought their resources on board. Bank of Uganda, we have FSDU, those are our strategic partners, and we have Opportunity Bank, we have KCB Bank, we have Bank of Africa being our platinum sponsors, Bank of Baroda, FICA, EcoBank, we have Uganda Insurance Association, we have BRAC, Private Microfinance, we have Stanbic Bank, Centenary Bank, we have PFC, we have our strategic partners as well, that is Summit Consulting, Housing Finance Bank, Yogaford, EPT, National Media, Bank of India, ABSA. Those are the members that have brought their resources on board to have this month successful. We still run quite a number of activities regarding this awareness month. And for details, I request you to kindly check out our portal. That's www.yourmoneycan.or.ug.
Your money can enable you to live a better life only when you budget and save before you spend. Act now. Learn how to manage your income and expenditure correctly at the Banking Financial Services Awareness Month. Meet the financial experts. Learn how to deal with financial hardships like those caused by COVID-19. Be money smart. Be part of the Banking and Financial Services Awareness Month. Visit www.yourmoneycan.or.ug. Brought to you by the Uganda Institute of Banking and Financial Services, UIBFS.